Hello everyone, welcome to my channel again. I am going to start my series of videos today as promised. It's New Year, so I have worked on my series of, I call them lectures, but they're really not lectures, they're going to be small videos. We're going to talk about, and this is going to be a long series which will discuss obviously currency, finance, conventional banking, our economic system and how to improve it to an ethical economic system, an ethical banking system, and all that good stuff. So it's going to be multiple videos on different topics. So the first topic that I'm going to discuss today is going to be money. So what is money? I know we all hold money in our pockets, dollar, euro, yen, rupees, whatever form of currency you use. But nobody has ever tried to even know what the definition of real money is. So there's two types of money. There is sound money and there is fiat money. So what is sound money? Let me explain what sound money is. Sound money has certain characteristics that it has to have in order for it to be sound money or sound currency. Uh, those characteristics are: it has to be scarce, it has to be tangible, it has to be fungible, it has to be transferable from one person to another, it has to be, it needs proof of work, and it should have store of value. So these are some of the basic characteristics of sound money. Now, what are all those characteristics? Let me explain to you, explain them to you one by one. The first one is that it has to be tangible. Tangible means it has to be a currency that we can see, touch with our hands physically. That's what it means. So for example, our rupees, coins, gold, that was all tangible. We can hold it, we can touch it, we can see it, we can feel it. Fungible. Fungible means if I have one unit of that money, it should be exchangeable to somebody else for the same unit of that money, and they both should value the same. For example, if I am holding a dollar and I exchange my dollar with your dollar, they both have the same value, so ultimately both of us don't lose anything. We got dollar for dollar and we're both even. That's fungible. So that's one of the characteristics of sound money. It has to be fungible. Number three, it should have store of value, which means it should be scarce. Sorry, that was the first thing. It should be scarce, which means there cannot be unlimited supply of money. It's limited, it's scarce, and that money should be enough for the economy, for the society, forever. There should be no need to create new money. For example, creating gold, you cannot create new gold tomorrow. It takes time. So it's always scarce because it requires lots of work to create sound money. Now that's my next characteristics, which is it should have proof of work. So proof of work, what does that mean? It means in order for you to get sound money, it should take you effort, money, and hard work. So for example, gold has been sound money for centuries, over 4,000 years throughout the history of humanity. And why is it so sound? Because even in the ancient Greek, ancient pre-Christianity, prehistoric times, gold has always been the medium of exchange since, after the bar trade, obviously. And it's sound money because it takes lots of effort, hard work, and money to get it from the reserves that are in the ground. So you have to mine gold, and gold mining is not easy. There's only 1% of the entire gold reserve that we have in the world is being mined every year. That's why it's scarce. It's not unlimited. That's why it's more valuable, because it's so hard and needs lots of effort and hard work to create new gold. You don't create it. You obviously have to mine it, and the mining costs effort, hard work, and all that good stuff, and cost, obviously. So we're only able to extract 1% of the gold that we have in the entire world, of the gold reserve. Next characteristic is they should have store of value. I think we were talking about this, which means it should have store of value. It should just increase. Its value should increase and not decrease over time. That's one of the characteristics of sound money. So for example, if you look at gold, its value has always increased throughout all these 4,000 or 5,000 years that I have talked about. It has never gone down in value. So it's constantly increasing. That's what makes it sound money. And transferable from person to person. So absolutely, if I have 1 gram of gold, it should have the same value. So if I have 1 gram of gold and you have 1 gram of gold, and they both have the same clarity, and they have this, sorry, same clarity, we can exchange. We don't lose anything. It's of the same value. Diamonds cannot be are not tangible because no two diamonds are alike. Their value is different, their clarity is different, their cut could be different, so they have different values. So if I exchange my diamond with yours, it's going to put somebody in gain and the other person in loss. So that's not fungible. Gold, on the other hand, is fungible, because if you have 1 gram of gold of the same clarity, etc., it should have the equal value, whether it's you're holding a gram of gold or I'm holding a gram of gold. Doesn't matter. It doesn't lose its value. So those are some of the characteristics of sound money. Now let's talk about what's the fiat money. Fiat money is a currency which has been decreed by someone. So in this modern time, current situation, the fiat money is paper money that we use, like dollar, euro, yen, rupee, dinar, whatever form of currency that you're using. And it has been decreed by the Federal Reserve, the federal government, or the federal bank, saying this is what we're going to use as our medium of exchange, and this is going to be our currency going forward. So it has no sound value to it. Do you understand? We might think, oh, I own this many dollars, but that dollar is actually useless and valueless because it doesn't have all those characteristics of sound money. It has been just decided by the society that we're going to use this piece of paper, which has such and such picture, and we're going to distribute this, and this is how we're going to use as a medium of exchange. And the second thing is, it's not scarce. We all know that in the name of this fancy name, in the name of quantitative easing, Federal Reserve has always printed new money. They turn the printer on just because they need excessive supply of currency in the economy. And what does that do to our economy? Once the excessive money is printed, because it's not scarce, it is unlimited supply available, and they're not putting there's no proof of work to create this money. And proof of work means if they were printing it actually on papers, it will still require some proof of work. Obviously, you have to turn the printer on, you have to use the ink, you have to use a certain type of paper, you just have to spend some money on it to print more money. But they're not even doing that. They just, with the click of a button, they just add this many extra zeros, and now we have so many $1 trillion floating in the economy. And who gets benefit from it? Obviously the banks, the state bank, the Federal Reserve, and then all the banks, and then the people at the top, they get benefit from it. And what happens when there's unlimited supply of money in the society? The value of money decreases. Inflation goes up. And by the time that extra money that has been printed come to the common man like you and I, things have already been inflated. When we say everything is so expensive, things don't get expensive. It's just that our money loses its value. I was reading actually somewhere a long time ago that if you held $100 bill in 1900, in 2000, that $100 bill will be only worth $4. So over 100 years period of time, you have lost 96% value of your money. So whatever you could buy for $100 back then, you can't even buy a fraction of that now. Does that make sense? So things don't get expensive. Money loses its value, and the main reason of the losing value of currency is because there's unlimited supply of currency. It's not scarce anymore. Whenever federal government decides to print new currency, they just turn on the printer. Oops, no printer. They just click a button, add so many zeros, money goes into the federal bank. From there it goes to all the other banks, and then there's excessive supply of money. Now banks are going to have, because there's more liquidity, so bank is going to lower the interest rate so they can have cheap money available to the consumers. And those consumers are, trust me, not you and I. They're going to be those big sharks who have lots of money and they need more money to expand their business. So they get at a very lower cost, and they get benefit because things are still cheaper and money is cheaper as well. So they got cheaper money, and they got cheaper commodities at a very low cost. By the time they've already bought or invested that money, the prices of things have already gone up because now the demand is higher because there's excessive supply of money and people want to use that money. But those big sharks have already invested so much into the economy, that now by the time it goes to the consumers, the demand is higher, but the supply is limited. We all saw this, what happened during COVID. There was excessive amount of money because Federal Reserve was doing quantitative easing, means printing more money, and there was excessive supply of money, cheap money available. Interest rates were 0%. There was no interest rate. Like, I bought my house with interest rate of 2.25%, and that has never happened in my lifetime, at least in the past. So it was cheap money available. So more people wanted to buy real estate, more people wanted to invest into maybe commercial businesses and stuff. And there was higher demand because now more people can afford it. So as a result, prices were going up because demand was higher, supply was limited, cheap money was available, and that's what causes the economic crashes in the societies in the world. So the two things that we learned is that obviously sound money is always better, the money that has all those characteristics that I defined, and fiat money that we are so proud of is evil money and we should refrain from it. This is the first video that I recorded. I'm going to continue this. I just wanted to explain what money was so people know what money is and what to treat as valuable money versus what to treat as just their everyday use money. And therefore, most of the big investors, they don't hold cash because cash loses its value. What they do is they invest into real estate, they invest into gold, dinar, bonds, all that good stuff, because then it just not only that real estate and gold retains their value, but they go up in value. So their dollar, if they're keeping them in the bank, is losing value every day. So be smart, be wise. Just the very basic video that I recorded just to give you a brief insight of what money is and how money works and how you should use your money, utilize your money, and what you should buy with your money so your future is secure. I hope this video helped. Please give my video a thumbs up. Subscribe to my channel if you haven't already. Please let me know if you like this video. It's going to be small, short videos, 10-15 minutes video, just like this one going forward, because I don't want to bombard you with the information with one video. I just want you to take it with a grain of salt, one by one, so you understand what I'm trying to educate you on. And I feel like everybody should be educated at least on the basic fundamentals of economic, finance, banking, currency, and all that stuff, and investment, obviously. I hope this video helps you understand, and please subscribe to my channel. Give me your thoughts in the comment section below. Please give my videos a thumbs up. Please share it with your family and friends if you find it helpful. Until next video, take care.